A spread bet on HSBC. Its January and HSBC holdings is quoted in the stock market at 9.51 to 9.52. You check the spread betting company and they are quoting a live price for March HSBC at 9.49 to 9.56. The spread betting provider's quote for a forward date will normally be slightly different to the price in the stock market because their quote reflects the effect of financing and dividends. Now, when you open a spread bet on a stock, you might only be required to put down, say, 10% of the value of your market exposure with the spread betting provider, financing the other 90% of the exposure. Obviously, they're not going to be doing this for nothing. That's why they charge you a bit more the further out the contract is. For example, the June contract is slightly cheaper to buy than the September one. Scenario 1. Sell. Now, thinking HSBC is overvalued, you decide to sell £20 per point at 949. Your bet is the equivalent of a position in 2,000 shares. This is because if you did own 2,000 shares, each penny movement in the price would be worth £20 to you. Over the next month, HSBC rises to 991, 992 in the stock market. The spread betting firm is now quoting March HSBC at 989 to 996. So you decide to keep your bet open, and by the time the bet expires in March, HSBC has dropped back a little and your bet is settled at 977, including the provider's spread. Your loss is calculated as follows. Closing price 977, opening price 949, difference 28. You lose 28 times £20, which gives you a total of £560. Let's look at scenario 2, and this time you buy. So, thinking the stock is cheap, you decide to buy at £20 per point at 9.56. You decide to take your profit. You close your bet by selling £20 per point at 9.89. Your profit is calculated as follows. Closing price 9.89. Opening price 9.56. There's a difference of 33, and you win by 33 times £20. You essentially win £660. For more information, visit www.financial-betting.com.